Welcome back, everybody. Welcome to week 13. This is block 1, labeling this watching and waiting. So then 2 weeks ago, when I kind of introduced the idea that we were going to have a 3-lesson series that goes over what I believe is the building blocks to a profitable mindset, right? And starting off with the easiest one, it is simply watching and waiting in the markets. So we'll get straight into it. Starting with that watching part, the art of observation in day trading. Right? This is how we remain objective, and it's by not actually placing trades. As soon as we decide to enter the market, there's going to be some level of emotional attachment to our trade or our money in that trade. Even if we're on a paper account, we still want that paper trade to win, but by completely remaining outside of the markets and watching them, this is how we can start to develop different ways to place trades, or if we already have a strategy, this is ways that we can, better get at risk management in moving our take profits, our stop losses, right? This is not putting any emotional barrier between what we should do and what we actually do, right? So the main objective is to remain objective. We don't want any emotion in this, seeing things that otherwise, would be clouded by the emotion, and look past the simple act of profiting and find consistency, right? So just watching the markets can serve so much benefit even though we aren't actively making money. That rolls right into what's next is reading the market, right? If we are just watching, we aren't worried about what's going to happen next. We can actually read the market and look at, okay, well, this is what should happen based on these confluences, or this is what should happen based on my strategy. This is what I should do if the market reacts in this way, right? When we talked about this, I want to say 2 or 3 weeks ago, we went over the idea of watching the other players in the market, right? If anybody was here for that or you watched the video, I know that one was fairly popular. Excuse me. Watching what the other players in the market do is so crucial because they're the ones that ultimately dictate what price will do, right? Our singular trades will not dictate where price goes. So we have to be able to look at the majority of people and say, where do they want the market to go? What signals can we draw from the market on an objective standpoint, not based on, well, it's almost at my take profit, so I'm gonna try and size in a little more. These are subjective reasonings. And there's no subjectivity in the market, right? It's everything has to remain objective because we don't have control over it. So looking at, right, if price is about to enter a support line, right? Something simple. But if we see the price comes down and it touches that line and it rejects, if we have money in the market, we're going to be very, very cautionary to stay in that trade because we know, hey, this is a signal that it's going against me and I have a reason to believe it's going to go against me, so I'm going to exit this trade. But if we simply weren't in that trade and we were just watching it, well, now this enables us to look, maybe we go to a higher time frame and we say, well, this was on the 5-minute where it rejected, but we just broke a key area into new lows on the 30-minute time frame, something that we might have missed if we were too focused on what's happening to our money right at that moment. Hopefully that makes some sense, where we're staying out of the markets to get a better key idea of where it's going to go. And that's going to bring me right into patience and timing, right? So more than watching, as important as that is for us to be able to not over leverage ourselves because we feel emotional, or to get out when we really shouldn't and we should just let the trade ride, right? There's waiting, not entering too soon. Sometimes you're going to get feelings such as FOMO, the fear of missing out. This is when waiting is crucial, and it ties in with watching. We start with watching, we start with not being in the market, but then once we have passed that and we feel comfortable to start placing trades, and we know that, we need to look at more than what we see straight in front of us, now it comes to waiting. Like I said with that example with the support level, rather than just having price come down, it reject a little, and then you get out, wait. Don't get out of that trade right away. Have a strategy that says, well, if this happens, I get out if it rejects it 2 times, right? We know a singular rejection isn't much of a reason to think it's going to hold, but if it comes down a second time it rejects, now you can start to ask, okay, is this something I really want to be in? Because it's shown the same price movement twice in a row where it's rejected a level, right? That goes into entry and exit strategies, right? Maybe we're not looking at it as a way of, oh, it rejected twice, so I need to get out of this trade. Maybe it rejected twice, so I need to enter this trade. You were out of the market, you were just watching, not being a participant, but you have seen the way price has moved, you've seen the way the other participants have reacted to price movement, and now you've decided, okay, I'm not going to enter when it only touches one time. I have to wait for it to touch 2 times or 3 times or 4 times, however much, added confluence you need or confidence you need to enter that trade. That's where patience and waiting to act comes from. Timing the market to you, but only under the market conditions, right? I want to say it one more time just so people understand. Timing the market to you, so under what you see your strategy, but only under the conditions of what the market is giving us. We aren't making any artificial indicators where it's just, well, my take profit is here, so I'm going to wait till there. Have a reason for your take profit to be there, right? I can't stress that enough, that it is important to remain objective in where you place everything, entry, stop loss, and take profit, as far as where the market wants to go, not where you want the market to go. Okay, that's where we're going to get that psychological edge. It's understanding that we can't control the market. We have to sit down and force ourselves to just wait, right? Maybe not even take a trade that day, or bring our total trades for the day down from 3 or 4 down to 1 or 2. These are all things where in the short term, it's going to seem like you're making less money because you're not taking as many trades, right? Maybe you're not taking any trades at all. Right? 2 big things that new traders want to do. They want to take as many trades as possible every single day. They don't want to miss a day. But ultimately, those are the traders that lose. We know this based on the data, that most traders who take more trades end up losing more. Okay? Into my week 1 challenge. This is really what this series is about. Okay? We're going to start on the left. I want to clarify too before I get into this. Even though it says week 1 challenge, this is not to be done in a single week. If anything, this should be done at a minimum over a month. The only reason I call it week 1 challenge is because this is our, first week or first block of the 3 lesson series. Okay, so hopefully that makes sense. But starting off, I want you guys to spend at least 1 full week watching. Right? This means that you're spending from Monday to Friday, whatever hours you trade, whether it be the New York, London, Asian session, whatever it may be, but you spend that full week just watching. We are not placing trades. If you have a strategy already, great. Watch for your strategy to work, because now you can see live what it would look like if you followed your rules perfectly. Right? So if you're not placing trades, you are going to, follow your rules perfectly by just, putting on a, whether you use the long or short tool on TradingView, right? Or if you use Fibonacci retracements, however you want to track where your entry, stop loss, and take profits go, right? Use whatever you want. But by just watching it, your strategy is going to be performed perfectly because you're not actually taking any, trades. Watch that for a week and see what kind of results you get. If you get negative results, right, and it's like, terrible, well, maybe give it another week if you know your strategy works, right? Give it 2 weeks, maybe 3 weeks, right? It all depends on the frequency of how many trades you get, what your win rate is, right? How much profit you get out of wins. So I recommend at least a full week, nothing less, but sometimes we may need more of just watching, not placing trades, because as soon as we start placing those trades, you're going to want to make changes. You're going to want to, change something in the strategy because you did something wrong, not because your strategy did something wrong. Okay. Next, hone your strategy. Exactly what I was talking about. If you see that your strategy is not working, right? Or if when you go to just watch the charts, remember we're just watching, and you see, well, this happened, let's go back to my support example, right? So let's say price comes down. Your strategy, and I'm just making this up, don't think this is like an actual strategy, but let's say your strategy is price comes down, you look for a support level, and it has to touch the support level twice and reject both times. On the second rejection, you enter after that candle has closed, right? So just, pretty simple. Hopefully everybody can understand that. Let's say that's your strategy. And when the market's active and you're just watching, we're not placing trades, and you see that price comes down and it doesn't quite hit that support level, but it rejects. It doesn't quite hit it, right? Maybe it's a couple points away. And then it comes down and it does it a second time. Well, if your rules don't specifically state that it doesn't have to actually touch the level, well, this is what we call judgment calls, where it's not specifically outlined in our rules what you should do, so you have to make the decision under emotional distress. This is what we are avoiding by just watching the markets. So while you are watching, you can then go in and say, hey, this would have caused me an issue if I was actually placing trades, but since I'm just watching the markets, I'm going to go back and I'm just going to add that to my into my rule book, right? Maybe you say it does have to actually touch the level. Maybe you say it doesn't have to if it comes within 10 points of the level or 5 points, depending on, whatever asset you trade, right? Some points are worth a lot more than others, right? Use ticks if you have to. Like for oil, I recommend ticks instead of points, right? Any of these things, they're very personal because it's your strategy, but they're based around market reasoning, right? The support level isn't there because you put it there. It's there because the market created it, and it rejected it not because you bought in and made it reject. It rejected it because the other players in the market agreed with that level and they made it reject, right? This is what I mean by remaining objective. Okay. And then once we moved past that, and we've spent an entire week or more watching the markets, we have honed in our strategy. We no longer have any of those judgment calls or those gaps in the rule book. We now start risking as small as possible. I recommend people, if you have the accessibility to it, to trade crypto, right? Because you can risk pennies on the dollar per trade, but still have a consistent risk level where it is as small as possible. But if you feel comfortable, using an evaluation account, do that as well. But I don't recommend opening a live account on the future side of things and trading that, because most often you're getting size where it's $10, $20 a trade. Well, $10 or $20 may not seem like much, but if you take 5 losing trades, you're down $50, $50 to $100, and let's say one of those you didn't follow your rules. Well, now you're getting, back into that realm of emotional distress. And now we have to start over because we've put ourselves in a bad position, all because we didn't risk small enough and we were hoping for that quick payday. Okay, this is what we want to avoid. There are no quick paydays. There are days, for example, I sat in a trade for 2.5 hours. It was very close to my, not final TP, but very close to my next TP where I would move my stop loss in profit rather than just break even. It comes up, almost hits it within the first 20 minutes, doesn't draw, comes all the way back to break even over the course of the next 2 hour 15 or 2 hours, that I was in that trade, and all the way back down. And then right before it stops me out break even, when I'm thinking, all right, whatever, it's a break even trade, is what it is, it shoots past my stop loss and I get stopped out for a small loss. These small losses add up just like the small wins add up. So it still sucks. But had I had that happen to me 6 months ago or a year ago, my reaction would have been completely different, to the point where it would have, first of all, it would have ruined my day. And that sucks because now I got to live with the rest of my day and it's going to, I'm going to feel crappy. But then secondly, I would have immediately sat down on my charts and I would have started back testing, and I would have said, well, I have to figure out a way to avoid times like that. I have to avoid. But we can't avoid times like that. We have to track what we made and say, you know what? The day before I had profit and it was $20 in profit over what I was risking, right? I got a little bit more out of that trade, right? That makes up for today. And that's exactly what happened, right? I track my amount that I make or lose each day, and I always try and be in the positives, right? If I risk 120, I try to get 130 out if I get 1-to-1. Right? Just a little bit more. If I'm at break even, try to get a little bit more. For days like today where I cannot control the outcome of the event, I am simply just subject to the market's movements. Nothing I can do about it. Okay, so that's why we risk small, to avoid any little emotional distress moments. And then Lastly, track everything, right? This, while I have it, the fourth thing that we go over, this should be the first thing you do starting on day one of your week of watching, right? Track everything. Track your trades. Track how you feel after you watch a loss, a win, or a break even. I noticed that when I was trading till 3 o'clock every day, I hated it. I did not want to be on my computer until 3 o'clock, from 9:30 to 3. It's not that long. It's like, a 6-hour workday, 5.5-hour workday. But I'm sitting there doing nothing because I have to watch the charts. So I went through, I backtested, and I said, well, what happens to my overall profit if I just stop trading at 1:30, right? Save myself an hour and a half. Well, first thing I noticed was nothing changed. Literally nothing. Like, the total profit was nothing. I just took a few less trades, but they worked themselves out to basically net zero. And I'm saving myself all that time, so I have more to do with my day. And then I went farther to say, well, what if I just took 1 trade a day? Instead of having, a maximum of 3 trades a day, I just do 1 trade a day. Same thing. Actually make a little bit more than I would have if I took 2 to 3 trades a day, or 1 to 3 trades a day. I make a little bit more over the long run. Am I taking less trades? Yes. Are my really good months a little bit less in profit? Yes. But the bad months are a little bit less in loss. So it evens itself out, and more than anything, I'm happier trading this way. That's the most important factor. The reason we watch, the reason we get the strategy to be specific, the reason we risk small, the reason we track everything is so that you are comfortable trading. If you're uncomfortable trading, you're going to make the wrong decisions. If you feel like you have to think way too much because your strategy isn't specific enough, you're going to be uncomfortable. If you're risking too much so you can't properly size in when things go against you, you're risking too much. It's putting you in emotional distress. Right? If you're not tracking everything and you go a full week or a month and you're like, man, how is my account down when it says I made 3R in profit this month? Well, now you're in emotional distress because you don't know where that money went. But if you tracked it, you would have known. I'm going to call it there, everybody. Again, thank you for joining me. Bring this over into next week where I'll be going over the second week. And, just a reminder, this week 1 challenge isn't meant to be done in a single week. Take screenshots of this. And of course, thank you guys for joining me. I'll see you guys next week.